All right, good morning, everybody, and welcome to RAISM's Foreign Investments in Florida Real Properties class, put on by GBC and Williams Parker. So I'm going to go ahead and introduce your two lovely instructors for this morning's session. It's going to be Miss Christina and Miss Nicole, and I will go ahead and let them introduce themselves a little bit farther.
Thank you, Cassidy. Thank you so much for having us. We both work at Williams Parker Law Firm in Sarasota downtown. My name is Nicole Christie. I work in the real estate department and I handle residential and commercial transactions.
And to make things confusing for y'all, I'm Christie Strasser, and I also work at Williams Parker with Nicole, but I work in our business and tax group. And I think we're going to start by giving y'all just a little overview of what we'll be talking about today. Obviously, Florida is a big place for all people want to move here, but especially foreign investments. And we think that this presentation will equip y'all with some important key things to be looking out for to help you issue spot with your clients who come in, what to ask, maybe what to look for when you're dealing with your non-resident clients with real property.
So why is this topic so important? One of the reasons why it's so important is because Florida has consistently for, I believe, the past 12 or 13 years been the #1 destination for foreign investors in US real estate. So they come for the tax benefits, the sunshine, the tourism, Disney World, and foreign investors make up 22% of all international residential purchases in the US and make up total 74 billion worth of residential properties purchased in the US between April 2019 and March 2020. So even with COVID, Florida's still, the top destination for foreign investments. Mm-hmm. So when you have a client who's looking to purchase property in the US, specifically Florida, you have to think about how they want to take title to that property. So what party is going to be on the deed at closing. They can take title individually alone. They can also do it individually with a spouse. In Florida, that is called tenants by the entireties, where when one spouse dies, the surviving spouse owns the entire property. They can also take title to the property with a family member or with just another third party. They can also take title in a U.S. trust that they're the creator of, or a limited liability company, partnership, corporation, entities that are formed in the US and also entities that are formed outside of the US.
Yeah, and as we'll get into a little bit more later on, there's specific reasons, tax reasons why non-resident individuals would want to take title by ownership with a corporation, non-US corporation or a US corporation. And of course, you have to also consider, just beyond the tax considerations, there's other reasons why that might not be the #1 priority for the investor. So there's a really fact specific, but we're going to address why, some of those reasons why they might take ownership in a certain structure.
So when does your client have to make this determination of how they want to take title? They should do it early in the process, and that's something that you can help them with. Ideally, they do it prior to the contract being signed so that the right party is on the contract. Some contracts limit the ability to assign the contract later to another party. So if they enter into the contract individually and then they want to take title in an entity, if the seller doesn't allow them to under the contract, that could be a problem. That's more common in commercial transactions, but if you check the box in the residential contract that it can't be assigned, then that could be an issue if the seller isn't agreeable. And also if your client is seeking approval by an association or a lender, you want to make sure that they have the right party so that it doesn't hold up any approval processes.
Right, so tax implications. So while taxes might not be always the main driver in how a non-resident individual or entity decides how they're going to hold property, of course, it's very important. And kind of what we've done is we've laid out here is the main types of tax consequences, and we'll dive deeper into each of them just to kind of give you a menu of the main things that could come up and you might want to be aware of. So we'll address the tax consequences of rental income. So that's the ongoing income that some of your clients might have. We'll address the tax consequences of the eventual disposition of United States real property. And then we'll also touch on the United States gift and estate tax consequences. And of course, all of these have to do with holding United States real property and specifically with a non-resident individual or entity holding this United States real property.
And I think one important thing to keep in mind is that you don't necessarily have to have all the answers, but just knowing how to issue spot so that when you're assisting your client, you can point out what could potentially be an issue and get the right team involved, whether it's a real estate tax attorney or a tax advisor, CPA, so that your clients feel comfortable with their purchases and confident and want to continue using it in the future.
Absolutely. And if you think, oh, I think I've heard that before, it might be significant, but you can't quite remember, always reach out to someone, accountant, tax attorney, reach out to us, and we'd be happy to let you know if you've picked up on something important. So the first question, because obviously we're focusing on foreign investors here, is we need to make sure we understand who is a foreign investor for United States income tax purposes and estate and gift tax purposes. So obviously it's someone who's not a US citizen, someone who does not have a green card, and someone who does not meet what's called the substantial presence test. So that's kind of a catch-all for everyone else who doesn't fit those first two categories. And just generally speaking, to keep the test as simple as I possibly can, it's basically looking at the current year that the non-resident individual is in or entity, and then looking at that year and then the prior 2 years. And you want to look at those years and say, was that person present in the United States for 183 days? And if they were, then they are considered a United States tax resident, and these rules that we're about to discuss don't necessarily apply. There is some overlap. We have a tax system where we have exceptions or carve outs, or, we have withholding rules that make it a little bit different than how we are taxed as US residents. But so that's going to be the significant difference. But definitely want to ask if it's not apparent that someone is a US citizen, you want to make sure you're figuring out, well, okay, you're a non-resident or you're foreign, you've come from overseas. How long have you been here? You want to make sure you kind of have those answers early on. And of course, it's not only an individual, it can be a foreign investor can be an entity, corporation, trust, partnership, and that's an easier test. It's simply the situs of those entities. Are you a French partnership? So that's a little bit easier, but individuals and entities can be foreign investors.
And that also, the substantial presence test is something to keep in mind if you are talking to your client about their future plans. They're currently a foreign investor, but they're thinking about coming to the US more often, and they don't want to become a US tax resident. They should be careful about not being in the US too much that they do become a US tax resident. I mean, there could be times where it's helpful to be a US tax resident, and there could be times where it interferes with their plans. So just kind of pointing that out to them. And I do see that we have some questions, so we'll just hold off until the end. You can keep adding your questions, and at the end we will go through all of them.
Perfect. Yeah, that's a great point. Just to give an example, a simple example of that, a lot of non-resident individuals have investments in our markets here, and for capital gains tax purposes, if they don't fall into some of the other exceptions, they can receive their income tax-free from those investments. So, if they don't have another reason to be here beyond vacationing, or making another sort of investment, they probably want to be careful to not trigger that substantial presence test and take away that tax benefit they have by the nature of not being a United States tax resident. So that first category on the main tax implications slide was about current income that's coming in for non-residents investments. Of course, we're talking about real property here. So there's a lot of other types of income that fall into the same kind of category, this passive income with rental income. But for purposes of this presentation, we'll be focusing on rental income. Generally speaking, the default for rental income is it's considered a type of passive income. And what that means is that it's seen as not associated with the trade or business here. And the tax implications of that is that it's taxed on a gross basis at a 30% rate. Now that means because you don't have a trade or business going on, you're going to take 30% of whatever rent that's coming in off the top, and that goes to the IRS. And we'll get into more specifics about that process and how that's done in just a little bit. But that's compared to, if you look below at the trade or business income, what's known as effectively connected income to a trade or business. So you have a rental trade or business. In that situation, you can offset income with your deductions. And then at the end of the day, once you've taken your rental expenses into consideration, you've taken your rental income, subtracted out those expenses, at that point, the normal graduated rates that we have as American citizens are applied. So I was talking about earlier, there's a blending of our tax system that's in place already for United States residents. So that is the case as well when you have a non-resident who's operating a trade or business here. And so we're going to go into more detail about both of these, but just the big picture is that on the one hand, you've got a rental, it's not a trade or business. On the other hand, you have one rental or more, and you have it, either you qualify or you categorize it as a trade or business and the different tax consequences. So the first one, passive rental income. Again, this is the default. It's unfortunately, it's kind of a disadvantageous way to have your rental income treated, but a lot of non-residents don't know about it. They just kind of go with it. They don't think there's another option. They have one rental property. Maybe they don't fall into the actual definition of carrying on a trade or business. They don't have multiple rental properties. And so this is the default. So like I said before, they're taxed on 30% of the gross rental income, and any expenses they're paying into that rental property for upkeep, maintenance, what have you, that cannot be factored in and deducted out of the tax that they owe. So how this works is the person who's renting, so the renter or the property manager, whoever is responsible in this situation, is supposed to withhold that amount. So if, for example, the renter is going to pay $10,000 for a period of time, they would subtract out or hold off on $3,000, and they are supposed to remit that to the IRS. And then at the end of the day, the non-resident individual walks away with $7,000, and then it's on them to go and file a tax return to try and see if there's any income that they overpaid, make sure if everything was done the right way. But essentially, that's the process, and it's kind of unforgiving, right? You're not offsetting any of your expenses that the non-resident had on the property. And just moving forward, we have a whole slide about tax treaties and how they can be beneficial, but this is just a type of income, particularly passive income, can often be offset by a tax treaty. So that's something to keep your radar up for as well. So this is compared to the other category that you can have your rental income fall into. So you have a trade or business. And there's, as I'll explain, there's two ways to get this treatment. The original way and the way that you fit it by definition is that you're carrying on more than just one rental property. You're carrying on a fairly significant amount of rental activity. So, it's continuous, regular, considerable. Something to note too is, maybe this is more common and you all see this if you have a non-resident who is investing and they're overseas, they have someone here who's managing their properties, an agent on their behalf. So their work would be considered in this equation. Is that agent managing the property frequently? Is he doing, or he or she frequently at the properties, doing a lot of work, something to take into account. So this is the general test that's looked at. And just as an example, if a taxpayer owned a single piece of real estate, kind of I've said that before, and under the terms of the lease, the tenant makes the repairs, and it's the taxpayer landlord who's required to make the real estate tax and premium tax payments. So we have a situation where, the taxpayer is kind of passive in the situation. So this is just an example of showing you what does not rise to the level of being considered a United States trade or business. However, a lot of non-residents do not know this, but you can also make an election to treat your rental income, regardless of the fact if you meet the test to be a trade or business or not. A foreign individual, a foreign person can make an election on a tax return to have their rental income treated as effectively connected income or as it's associated with the trade or business. There might be reasons why someone doesn't want to do this, but to me, it sounds like a no-brainer. If you can make this election and you can offset your expenses that you're funneling into your rental business or your rental property, and you can offset your income and, come out with a smaller tax bill at the end of the day. In order to make this happen, the taxpayer, if it's an individual, they have to file for an individual tax identity number. Or if it's an entity, they have to have an EIN. And this is because if you have a trade or business in the United States, you have to file a tax return. And in order to file a tax return, you have to have, we all know the drill, you have to have your social, or if you're a non-resident, you have to have some kind of identifying information to put down so the IRS can keep track of you. So I think we touch on this later too, but that's something, they want to do that at the outset here of coming to you for help. You want to ask if you find out that they're non-resident, you want to ask right away, do you have an individual tax identity number, or does your entity have an EIN? Let's see. And then there's another form. There's always form requirements with the IRS, but you have to, or the non-resident would have to provide form WECI to the withholding agent. Again, generally is the renter or the property manager in this situation. All right, so this, again, I kind of just touched on it, but filing requirements. So if you are a non-resident individual, you're required to file a tax return in these two situations. There's some other more specific situations, but I did the ones that I felt were kind of most applicable for purposes of this presentation. The biggie one I was just saying, if you're engaged, you're a non-resident, and you're engaged in a trade or business here in the United States, you gotta make a filing, and that includes, as you'll see later, it includes running an actual trade or business. It includes if you just have one rental property, and like we discussed before, you simply made the election to be treated as a trade or business because of the advantage of being able to offset your expenses. So this pulls in all of those categories, and then it also pulls in anyone who is not engaged in a trade or business, but they think that that the U.S. income tax that they owe will ultimately be more than what was withheld. So those are the two main ones. And again, you have to have, when you file, you have to have that identifying tax number, and something that's pretty important here, because it's kind of not, it's all for nothing if you don't file in time and you can't take advantage of offsetting your income, your rental income, with those expenses and those deductions you're allowed to take. So there is a time frame here. You have to file within 18 months in the case of a foreign corporation, or 16 months in the case of a non-resident individual. And just a side note, I know you're seeing non-resident alien. I just want to, in case anyone is sensitive to that word, it's a technical term. I know that's not usually used anymore, maybe not politically correct anymore to use, but it is a tax technical term, so that's why it has been included. Okay, so moving away from rental property, your ongoing income that you would receive from real estate, we get to dispositions of real property in the United States and the tax consequences. So you might have heard of it before. It's called FIRPTA. It stands for the Foreign Investment and Real Property Tax Act, and it applies to foreign persons, individuals, and corporations who make a sale of any United States property or real property interest. So why this was enacted in the 80s, it was in the early 80s, it was enacted because Congress realized that we had this situation where we had non-residents come here, invest in property. And I'm not saying it was, malicious or not, but they would sell their property. There were no tax consequences because they would leave, and the IRS, they would go back to their home, country, and the IRS had no way to track them, no way to recoup that tax that they were supposed to pay. So this was enacted, and as we'll go into in detail, it ensures payment because it works off of a withholding system. And what it does is it requires any buyer of United States property who's buying from a foreign individual who has the money, they're the ones paying, right? So they have to withhold an amount of tax and remit it to the IRS. Something to note about FERPTA tax and a sale of United States real property, it's automatically considered as trade or business income, which might be confusing to you because it can be any, you could not be carrying on a trade or business under any other definition, but because of the way the code works and because of the rules, the Congress and then with the regulations, the IRS wanted to apply to the situation, it's just deemed as effectively connected trade or business income, which means, of course, as we discussed, you're required to file a tax return. So beyond having a non-resident individual, you have to have United States real property interest here at play to have the tax apply. So without getting too into the weeds, I think we can all, US real estate, real property, it can get way more specific than that. As you can see, you can look through entities and deem the interests that individuals hold in corporations and partnerships and trusts. Those can also be deemed to be United States real property. So what this is getting at is that the IRS is trying to make sure we're capturing all of those instances where people have put their property into an entity and try to, sell the interests in the entity. And they're saying, oh, well, it's indirect. I'm not selling real property. I have an indirect interest. The IRS says no. In these situations, if it's a corporation and more than 50% of the assets in the entity consist of United States real property, we're going to consider your interest to be United States real property. And then with these pass-through types of entities, partnerships, trusts, in that situation, it's kind of just a linking of the percentage interest owned by a person. So if you own 10% in the partnership and the real property is sold, the partnership sells the real property, you are liable as a non-resident for 10% of that purchase price. FERPTA tax will apply to that. Something else to note, and I believe Nicole has something to add on this, but joint interests, it's common to see that there's family here, that maybe mom is a United States resident, maybe son is a UK resident. And so you have to take into consideration there, how will FERPTA split out in that situation? Because mom is a United States resident. So she shouldn't have to have a FERPTA consequence and have to go through the withholding that is required. And then
for that, one thing to keep in mind is later on, we will talk about certain exemptions that apply based on the purchase price. And I've had situations where people want to split out the purchase price and say, well, I only own half of the property. So I meet, I'm under the threshold, but you have to look at the entire purchase price to see whether you meet exceptions that we'll talk about later. But if you determine that you still have a withholding, then you only have to withhold based on whatever interest that particular seller has in the property.
Right. And then this is less common, but figured I'd throw it on here just in case. It is possible for a creditor to have United States real property interest by virtue of it having, lent money, a lien on property. It can't be a loan. That can't be the only interest that the creditor has. But if, sometimes you see other profits interest or income streams associated with a creditor's interest in the property. And so in that situation, you could have a FERPTA consequence to that person, to that individual, if they're a foreign owner. But generally speaking, if it's just a plain creditor and they're foreign plain creditor, that would not be considered, their ownership will not be considered United States real property interest.
Okay, so as Christie explained before, FERPTA centers around a withholding process. So the withholding is not the tax itself, but instead it's a deposit that is collected and applied towards the tax when it's ultimately due. So generally, the tax withholding is 15% of the seller's gross sales price, which is the purchase price on the contract for the real property, subject to some exceptions that we'll talk about later. And so that tax withholding has to be remitted by to the IRS within 20 days after the sale. And like Christie explained before, it's the buyer that is responsible for making sure that happens. So if your client is the buyer and you want to make sure that you determine early on in the process whether or not the seller is foreign. If you suspect it, typically in the closing process, the closing agent will send a questionnaire to the seller asking whether or not that seller is foreign. But sometimes the seller doesn't fill it out. So just kind of getting ahead of things and making sure your client as the buyer is covered, because if the buyer does not meet the withholding obligations, not only are they subject to the outstanding tax, but also because, once the seller collects their money and moves on, there's not necessarily a way for the IRS to actually get that tax. And then the buyer is also subject to penalties and interest. And so, like we said, the withholding is not the tax. The foreign seller will then file an annual tax return, and the IRS will calculate the actual tax due on the gain. And so if the tax is more than with the withholding, then the seller will have to send in more money. And if it's less, then the seller will get a tax refund. And I think, Christie, you had a comment about what actually happens with the taxes.
Yeah, so just to give some more color to this, you have to, it's fact specific. So, if you have a corporation, that's going to be our corporate rate here that will apply. And if you have individuals, as we talked about before, FERPTA is ECI, it's trade or business income. So that person gets put into our standard United States brackets, assuming capital gain, you'll be within those amounts. But if it's a corporation, not a pass-through that ultimately funnels to individuals, it'll just be that corporate rate. But I think, we were talking about this earlier, I think it's so rare to have a situation, probably nearly impossible unless something was done wrong, to have a situation where the tax ultimately due should exceed the withholding that was taken. So typically, that's definitely something that the foreign seller is going to want to make sure they get done properly, because they should have some kind of a significant refund.
Okay, so the FERPTA tax withholding process, it is built into the FAR contracts that you guys use every day, approved by the Florida Realtors and the Florida Bar. So Section 10I of both the standard contract and the as-is contract requires a seller to make a written disclosure to a buyer if they are considered a foreign person under FERPTA. So if you represent a seller, just make sure that they are making that disclosure and letting not only the buyer know, but also the closing agent, and getting a CPA involved if necessary. Also, Section 18K in the standards section covers the withholding requirements, the process, and the various obligations of the buyer and the seller.
Mm-hmm. Yeah, and
they
just
don't necessarily need to amend the contract if there's a foreign seller, because there is a built-in process.
Mm-hmm. Yeah, and I was going to just note here too, to be careful with disregarded entities. So for tax purposes, United States tax purposes, a disregarded entity would be an LLC with one owner. And the United States does not regard them as the taxpayers. So there's a look through, it's the actual person, whether it's another entity or an individual who owns that limited liability company. So whether it's intentional or not, a seller may put down their LLC and, you check it out. It looks like it's a Florida LLC. Oh, no FERPA issue here is what you think. But no, I mean, there's a possibility that the actual owner, if it is a single member disregarded LLC, is foreign. So just be careful of that, and just make sure you're kind of asking those questions to make sure you fully understand who the owners of an LLC are and what's really going on behind the entity.
So who are the other players in this process? So even though under the statutes, and the laws, the buyer is the one who is technically, responsible for making the withholding, in reality, what actually happens is the closing or title agent will collect that tax withholding on the closing statement. You'll see it when you're reviewing the closing statement. So if you know that there's a foreign buyer and you represent either the seller or the buyer, just be on the lookout for that and make sure it's being collected. And so the closing agent will do that as a courtesy and then will remit the amount to the IRS. So that's also one of the reasons why it's so important to let the closing agent know right away, so that, and if your closing agent is a real estate attorney, it is helpful, that attorney can help provide advice on whether any exemptions are available, and also help you determine whether you need to get a CPA involved or a tax advisor. They're the ones that will answer any other questions, prepare forms like the withholding certificate, which we'll talk about in a little bit. So the seller will, ideally want to avoid having to do this withholding, potentially having their money held up for quite some time. So there's one exemption where no withholding is required. And this is determined by kind of two factors. One is if the gross sales price is $300 or less. So the purchase price on the contract is no more than $300. So if your purchase price is $400,000, you have to do a withholding, and this doesn't apply. Kind of the next factor is the buyer's intended use of the property. If the buyer or a member of the buyer's family intends to use the property for personal purposes as a resident, at least 50% of the time the property is actually being used, whether it's by a renter or by them, in each of the following 2 12-month periods, then the withholding is not required. So you're going to end up, if you're representing the seller, you want to get with the closing agent and talk to the buyer, find out what their intended use of the property is. So if they intend to just rent the property and never use it, then this doesn't apply. But if they intend to use it for their own use or a family member's use, then, and that, depending on who they intend to use it, you want to be careful that it meets the criteria of a member of the family. So that's maybe one thing you'd seek a attorney or CPA's advice on. But you look at, so for the first year, if they're going to rent it for 50 days, if they intend to use it for at least 50 days themselves also, then that potentially meets the criteria. And then the same for the next year. So it depends on how much they think they're going to end up renting the property. And it's based on their intent, but there is a look back. So the IRS could potentially look back and say, well, you never used the property. The buyer never ended up using the property for personal purposes. And so the buyer can get themselves into trouble that way. But there is an exception for, a change in circumstances. So if they, in good faith thought that they were going to use it and then something came up, they are not necessarily going to get into trouble. But so if you represent the buyer, you want to be careful, make sure they understand what they're agreeing to, because they will ultimately end up signing an affidavit swearing to their intended use of the property at the closing. Because all of the closing agent, all of the parties are going to be relying on their intended use not to make the withholding. But I do want to point out that just because the withholding is not required at closing, the tax is still due. So the seller will still end up filing their return and paying any taxes on the gain. So if the purchase price is over 300,000, but it's under $1 million, they could potentially be entitled to a withholding reduction. So prior to 2016, the tax withholding was 10% of the purchase price, and then it was raised to 15%. So this exemption allows a seller to reduce their withholding to the original percentage. So if the purchase price is 400,000 and the buyer intends to again use the property for their personal use as a residence within the that standard, then this reduction in the withholding is available. And again, what ends up happening is the closing agent again prepares an affidavit for the buyer to sign, stating their intent. Technically, there's not a, for this exemption, the law just says buyer intends to use the property for a residence, but best practice is using the same test as the other exemption, where you look at 50% of the time for the 2 years following closing. So sometimes sellers want to apply for a withholding certificate, and the form that gets filled out to apply is called the IRS Form 8288B. This is going to be completed by a CPA. The seller is often not going to know the proper information to fill out to properly apply. So that's one of the reasons, if you're representing a seller, you're going to want a foreign seller, you're going to want to ask them from the outset whether they intend to apply for a withholding certificate. And so why would a seller apply for a withholding certificate? They would do that if the maximum possible tax would be less than 50% than the 15% withholding. So if they are at a loss, and as Christie pointed out, usually the taxes do end up being less. If it's a significant difference, then maybe this withholding certificate is favorable. But you also want to consider the time of year. So if your closing is at the beginning of the year in January, the calendar year, you have to withhold your 15% of the purchase price as the seller. And then that money gets held until you file your tax return the following year, and you have to wait all that time for a potential refund. And so that might be a time where you do want to apply for the withholding certificate. But if your closing is at the end of the calendar year, then you will end up filing your tax return shortly thereafter, and you may get your tax refund within 4 or so months. So in that situation, it may not be worth it because of the time it takes to actually get the withholding certificate back from the IRS. So when does your seller apply for that certificate? They have to wait until after the sales contract is signed, because the way that they establish evidence to the IRS that their maximum possible tax is less than the withholding is by establishing what they purchased the property for, factoring in any capital improvements and closing costs associated with the purchase compared to what the amount that they're realizing. So the purchase price, any commissions, closing costs, and their maximum taxable tax rate. So in order to know what the purchase price is, you have to have a signed contract. So you have to wait to apply until you have that signed, and then you have to apply on or before the closing date. One other thing to keep in mind is all parties to the sale, the buyer and the seller, have to have an ITN or an EIN in order to apply for the withholding certificate. So the foreign seller either has to have it or has to apply for one at the time of filing for the withholding certificate. So when does the seller receive the certificate? Generally, it's 90 days after you apply, they apply. But these days with COVID, and also depending on the time of year, it can be much longer. So I've heard from CPAs that they're really not recommending sometimes sellers from even applying for the withholding certificate, because by the time they get it back, they're going to already have their refund. So it's not necessarily worth it. But if they do end up applying and they get, say, typically these days closings, you're seeing 30-day turnarounds or less. So you're not going to get the withholding certificate back in time. But say you had an extended closing date, 4 months from the time the contract is signed, you may have the withholding certificate back before the closing. So the closing agent, rather than withholding the 15% or the 10%, if it's reduced, they would withhold just the amount on the withholding certificate, because the IRS is telling them this is all you have to withhold. If the closing takes place before the certificate is received, which is more common, then the withholding is still collected by the closing agent, but then it's held in escrow pending receipt of the withholding certificate. This is a whole process. This is another reason why, if you're doing a withholding certificate, you want to get the closing agent on board quickly, let them know, because there will be a whole process to, setting up the escrow.
Okay, so then this next slide, just a quick note to tie in how non-recognition transactions. So when I say that, I mean like a 1031 transaction ties in with FERPTA. So the code and the regulations are a little stricter, fairly significantly stricter on foreign individuals and what they have to prove, what they have to show, and the filings they have to make. So it's just good to know that generally some of these are available, but you have to jump through more hoops and there's more involved, kind of like Nicole was just saying, and this is also its own separate process. So if you have any clients who express interest in this, probably enough to say, that it's more complicated than it would be for a United States citizen. But then if they're really interested in pursuing it, you can set them up with a tax attorney or a CPA to help them out with that process and let them know if it's even possible, depending on the facts of the situation.
So another thing to think about, if you have a client that is intending to, a foreign, client looking to invest in property, as Christie mentioned before, when they're foreign, there may be, high tax rates on their income, on selling the property. And so to figure out whether the whole, deal is worth it, they're going to also want to take into account not only the federal taxes that they're going to incur, but also just the Florida and local taxes. So in Florida, we have no income tax other than corporations, but we do have real estate taxes. We have transfer taxes, so doc stamps. You're all familiar that we collect doc stamps, 70 cents on every $100 of consideration, the purchase price at closing. Under the contract, it's typically a seller responsibility, so they would be paying for it, and that is how Florida makes their money. And so they also have to consider income tax if it's a corporation, and if they're planning on renting this newly invested property, they have to think about sales tax on any commercial leases, which will most likely be collected from the tenant, but just keep that in mind. And if there's a tax, if they're doing short-term rentals, there could also be a tax. So just keep in mind that they, just to balance out, what their ultimate cost is going to be. Another thing maybe for them to keep in mind is, they're going to want to think about the various structures of, if they're forming an entity, what benefit they'll have from that. But they also need to weigh that against, the cost of forming and maintaining an entity. And is it worth it for, the benefits they're getting out of it?
Yeah, absolutely. And then just a quick note on this, so it's on your radar, what specifically applies to foreign corporations. So the best way I can explain this is in the United States, we have corporations, we have C corporations, and we have S corporations, and the S's are treated like pass-throughs. There's one layer of tax. For C corporations, there's two layers of tax, right? There's the entity level, and then when the money eventually gets distributed up to shareholders, at that point, the shareholders pay another level of tax. So kind of like Congress realized, hey, something's going on here. We're not getting the tax, we're not collecting what we need to from these foreign investors with respect to real property. They said, hey, wait a second, these foreign corporations are coming in, they're running their business, they're making a bunch of money here, and yeah, they're paying the entity level tax, but then they leave the country and the ultimate shareholders don't have to pay that second level layer of tax. And so not only was the IRS, the United States missing out on that tax revenue, but it was kind of making it unfair for United States citizens who run their businesses through C corporations. And so this was their solution. And note, this is specific to foreign corporations, so not US corporations here with foreign investors. This is a foreign corporation who's engaged in United States trade or business here. And specifically why I brought this up for real property is because if you recall earlier, the type of income that FIRPTA generates when people sell their property is technically considered trade or business income. So it's pretty funny to think about, but without even really carrying out a full trade or business, you didn't hang a shingle and you have a full-blown business running, you just sold a piece of property, but that could be enough to be the right type of income that pulls the applicability of this tax into play. So just something to keep in mind if you have your clients, they're foreign, you know that they're going to be purchasing through a corporation, a foreign corporation, which has its own different benefits, for other tax reasons, but it's something to keep in mind that this is a potential tax that would apply. And as I have here, it's a flat 30% rate. It's a very complex calculation. It's kind of looks at the overall over a period of time income that's brought in and does a calculation based on that. But basically a 30% tax rate on money that would be divested out of the United States. And I didn't get specific on it, but there is a limited exception. As simple as I can put it, we give an exception to those foreign corporations who have had their time here and they're out for good. They're not going to be investing kind of in our markets and getting capital gains benefit treatment. They're out for good and they're not going to be reinvesting. So that's the branch profits tax, just something, don't want to get too heavy on what it all means, but just something on your radar. Beyond just the income tax, something that your client should be considering are the gift tax and the estate tax. So for non-resident individuals, the gift tax applies to United States tangible property that they make a gift of during their life. So something that's nice here to note is that gifts of intangibles made by non-residents are not generally taxable in the United States. So that's a big deal, and a way that potentially, if the right structure is set up early on, a person could gift real property if it's in the right entity and the interests are gifted to a relative or whomever they wanted to gift that to. Now compare that to FIRPTA, right? So FIRPTA is an income tax consequence. And like I said before, there's various provisions that look through the entity, depending on the structure and depending on the makeup of the entity. But here it's fairly clear in the code and regulations that if you're gifting an intangible, a non-resident will not be subject to gift tax on that intangible. Beyond that, non-resident individuals also have the benefit of the $15,000 exclusion, annual exclusion that we as United States citizens have. So that's nice. It's to any one individual, you can give $15,000 and not be taxed on it. It's $30,000 for spouses. However, what non-residents do not get the benefit of is the lifetime gift exclusion that United States citizens, at least for now, we have, and it's a fairly large sum. Right now, it's about $12 million for an individual, and what we'll talk about on the next slide with estate taxes, gift and estate tax exemptions are linked for United States citizens. The point I'm making is that the non-residents do not get that to their advantage. So if they're going to be gifting a direct interest in real property, that is a tangible asset, right? That's not an intangible. They could have beyond the $15,000 of an exclusion, they could have a pretty hefty tax bill. And the top gift tax rate is 40%. So they could be looking at a big gift tax rate. So if you have clients who, maybe you're just before they're about to buy property, they mention that they might want to gift it eventually. Maybe your radar goes up and you remember something about this that, well, if you put it into an entity, while there might be other reasons why they don't want to do that for gift tax purposes, that could get them where they want to be later on. Something else to note is that FERPTA, we talk about that as an income tax consequence. However, technically, FERPTA covers all dispositions of real property. But the reason why FERPTA doesn't apply to gifts for the most part is because there's no amount realized by the donor. So, if I'm just donating my property or I'm just gifting my property to someone, I'm not receiving anything back. So I don't have an amount for the IRS to tax. However, exception to that is in situations where someone has a mortgage on the property or some other type of lien on the property. And by gifting it to an individual, they are removing that obligation from themselves. So that's technically a financial benefit to them. And in that situation, FERPTA could apply. Reporting, we've been talking about it, the tax returns you have to file, the forms that need to be filed, again, without getting super specific here, because if you have a client who has a gift situation, you need to put them in touch with the right person, but there are going to be gift tax reporting requirements. Oh, sorry about that. Oh. Sorry. Okay, so estate tax. So as I was saying before, in the United States, as a United States citizen, the gift and estate tax are unified for us, and we have this big exclusion. It's currently $12 million per individual that for the most of us, it keeps it such that we never really have to pay gift tax or an estate tax. However, for non-residents, that's not the case. Their exemption, so on estate tax, so that means when they die, if they die holding United States real property, then that's going to be included in their estate and it will be taxable beyond $60,000. So as I said, they don't get the big exclusion that we get the benefit of. And again, the top estate tax rate is 40%. Something to note here that's different from gift tax. I talked about gifting intangibles. Non-residents gifting intangibles generally exempt from gift tax. That's not necessarily the case with estate tax. It's not as clear. The scope of the property that gets pulled into the estate tax is broader. And so intangible property, if US situs, will be pulled in. However, if you have intangible property that is non-US situs, that will not be included.
And also one thing to keep in mind is that the property that are factored into your estate, the person's estate taxes, is not just things that were held in their individual name. It also includes property in their trust. So even though if it's not going through probate, it's still going to be factored in for their estate taxes.
That's right. Absolutely. Yep. So again, a 40% rate like gift tax. And then something that is nice, probably limited, probably not all that common, but if there is United States citizen spouse who has a non-citizen, non-US citizen spouse who dies, that US citizen spouse will be able to inherit any of that non-resident individual's assets when they pass without a tax consequence. So there's a marital deduction. So in the United States, go ahead.
Sorry, go.
You're good. Oh, I'm good. I'm done.
Okay. Just one other thing a client should keep in mind when they are, taking title to their property. When citizens take title to property as husband and wife, and the first spouse dies, they have an exemption where you don't have to pay the estate tax when the first person dies. And when the second spouse dies, that is when the estate tax is due based on the value of the property. However, not all non-US citizens are entitled to that benefit. So when the first spouse dies, you pay the estate tax on their estate on the entire value of the property. And then when the next spouse dies, you potentially have to pay it all over again. So that is, that you're basically you're paying twice. There is a way for them to avoid having that happen if they're, really intentional about the way that they take the title to the property. So at the closing, if they're able to document that they paid separately for their half of the property, so by separate check from different accounts showing that I paid half, she paid half, then you can potentially limit the amount of estate tax due upon the first spouse's death to just half, and then the next spouse also pays half when they die. But that is something that has to be done, you kind of, documented at the closing and thought about ahead of time. So just something to keep in mind, that's potentially, a hangout that they're going to find later when they pass away, that they could have avoided if they had planned at the closing.
Right. And then just last note on the estate tax topic. So just touching back up to what property is pulled in here, right? It's US tangible property and US intangible property. So what we have seen done is we'll have foreign individuals who will have a structure set up where they own interests in United States entities, but the ultimate holding company is a foreign corporation, right? So while that pulls in other consequences, the branch profits tax we were discussing before, you have to now worry about that potentially. It does alleviate estate tax potentially, so that when that person dies, they do not have United States situs intangible property in their hand. They have foreign shares in their hand. So that's it's a give and a take. I guess that's kind of a big point of these tax consequences. It's kind of very fact specific because you make one move to help with one tax consequence, and you might have to deal with another. So it really just depends on what your clients would be most interested in help with. So state tax. And then we've kind of woven it in a little bit. Tax treaties are another way that you can have an exemption from some tax. A non-resident can. So there's income tax treaties and there are gift and estate tax treaties as well. We have a little statistic up here about the number of income tax treaties that the United States has entered into. These treaties can help alleviate current income tax consequences associated with property. So rental income, really typically any type of passive income, you're more likely to have a treaty completely eliminate income of that nature. However, generally speaking, treaties do not alleviate FERPTA tax. So you sell United States real property, you're a non-resident individual, the treaty is not going to help you out much. And that's really because what the treaties generally say is that the jurisdiction that has the situs of real property has the right to tax the property. So, it doesn't really help someone that much. Say it's the UK-US income tax treaty, and it tells the US or where the property is located that they get to tax the transaction. Well, great, we already know that because of FERPTA. So that is the one type of tax, real property dispositions, that treaties really don't help out much with. But they can help with withholding, reducing withholding rates. And then gift and estate tax treaties are separate from income tax treaties. And there are a number of those that can provide full relief from either gift and or estate tax. So something else to keep on your radar, if you have foreign individuals, you might just want to ask them if they've considered a treaty in place before they decide how they're going to take title to their property. Or of course, always reach out to a CPA or a tax attorney if you have more specifics on these questions. And then, sorry, just a disclaimer, this video is educational. We're covering general topics that, the general rules that apply to real property, taking title to it, tax consequences. But as we've been saying, every individual's circumstances are different. And so, don't use this as educational, but if you have a specific situation with a non-resident client, you're going to want to make sure they get the right specific tax advice for their situation.
Okay, so time for some question and answer. We have our contact information up on this last slide. So if you have any specific questions now or later, if you come across a foreign buyer, seller or buyer and you need assistance, feel free to reach out to us. So the first question had to do with just the categorization of who is a foreign investor. So they asked, how about a US citizen that's living overseas for 3 or more years? I'll let you take that, Christie.
Yeah. So in that situation, they should not be deemed a non-resident. I'm pretty positive for a United States person to completely lose their tax status. They need to have, I forget what the word is called, but basically have renounced United States citizenship. So, I don't know this. I don't know the specifics on timeframes and, when renunciation has to occur, but I'm pretty positive that you remain a United States tax resident when you leave.
Okay. So previously you mentioned how even if rental income is not in of itself categorized as a trade or business income, that the person can elect to have it treated that way as if it was a trade or business. So somebody asked, how can they just elect to have it treated that way? So I believe you explained that it's through a form, and it's a little weird. You'd think, like, why would they allow that? But you mentioned before that it's actually, a little sneaky on the IRS's part, because once it's deemed trade or business income, they have to file a tax return and they're more likely to pay their taxes. So it probably is actually beneficial for the IRS.
Right. That's just a guess as to why. I mean, it does seem very strange that they, we have a categorization, we have a kind of a common law test and a tax common law test, and then you can elect, but no, an election can be made. And it's even on the IRS's website if you feel like getting more information, but they would just elect on a tax return for that election. And there's a specific form that needs to be given to the withholding agent to also facilitate this process, but the election itself is made on the tax return.
And not everybody knows about this, right? Like, you have to specifically know about the ability to elect.
Mm-hmm. I think for the most part, most non-residents think that it's just the flat 30% on passive income, and they might not even know more about the trade or business designation at all. So I think the general idea that non-US citizens have is that it's like a passive income type of tax.
Okay, so when we were talking about the FERPTA withholding and the exemptions, we talked about the exception to the withholding requirement when the buyer intends to use the property for personal residence. So someone asked, why does the buyer's use of property affect the seller's tax liability? So it's not that the buyer's use of the property affects the seller's tax liability. The seller, regardless of whether there's a withholding, is going to have whatever taxes that are due, they're going to have to pay them. It's just whether or not the money is being withheld ahead of time. And it's actually the buyer's obligation to withhold in the first place. Mm-hmm. So it seems like it's helping out the seller, but technically it's the seller's obligation to have it happen. So I don't know why, I don't know the reasoning, but that's just what the law says.
Mm-hmm. Yeah, and it it's confusing to remember this, but at least for me, I have to remind myself, oh yes, this makes sense because the buyer is the one with the money. They're the ones paying it anyways. So it's not really like it's I mean, it is a burden on the buyer, but you know, it's not like they're paying a tax or, you know, in any way financially suffering because they owe that money anyways for the purchase. They're just holding a portion of it back.
Another reason why I think the onus is on the buyer is because once the seller is gone, they take their money with them, and how is the IRS going to track them down? But the buyer has the property. And so that is a way for the IRS to get
Right.
some relief. So someone asked whether the slides are going to be emailed to everyone. I don't know about that. We don't have everyone's emails, but if you want the slides, you're welcome to email us at these emails. I don't know if Cassidy has is going to distribute the slides or not. I'll let her kind of
Speak to that.
Does anyone else have any questions before we wrap up? Someone that said thank you. Thank you for coming.
Thank you.
Do you have other offices in Florida? We are just in Sarasota. So we're right downtown. But we can help, you know, especially with increases in technology, remote online notarization, the ability to get a mobile notary, you know, we help people all over the state of Florida. So we do closings and, you know, give other, you know, legal advice to people in Manatee County, especially, but also, you know, Palm Beach. So we're kind of all over.
And tax advice specifically, because we don't, you know, we're not paper intensive like real estate attorneys have to be, but we help people, we help non-residents in the UK. So we do have quite a reach.
Okay, I think we're
All good.
wrapped up.
All right.
Thank you so much,
Thank you.
everybody.
Yeah. Thank you. And let us email us, please, if you have follow-up or any other questions.